Hey, Dustin Tibbetts with Passport to Wall Street, and today we're doing our trade of the week, my favorite one to do every week. We're going to look at a short position on a relatively strong stock right now, but we're going to be very careful about it. We'll use options today because we have focused on options a bit in our sort of weekly videos that we do to teach you guys. And so let's get started. The stock is actually very common. You've heard of it before. It's Starbucks. And if you follow Starbucks, they had earnings just this week. And that caused a rather sharp rally, a very, very strong rally that pushed them to new highs. So let's take a look at that real quick. Here's the daily chart of Starbucks, and the blast off that you see really starts back on the day of earnings. So basically everything came in much better than expected. Growth was better than expected. It has added about 17% in just those few days since it reported earnings. Now, what I'm looking at here is just a stock that's maybe gone too far too fast and could take a break. I'm not saying that the stock will fall. It is actually very common that a stock blasts off after earnings and then sits and does nothing, especially Starbucks if you happen to follow this one. So, here's what we want to do. We want something where we can benefit from the stock either stopping and moving sideways, or maybe it does pull back this time, and so we'd like to make a profit from that. This will be just hopefully a quick trade. And so what we'll do is look slightly higher and go, hey, there's the round number of $70. What if we go over to the option chain, look in the December monthly expiration, and because you've seen our videos on how to choose the expiration, then now you know, right? So we'll look at the $70 calls. It's currently the market's closed, so this shows a little bit of a spread there. Let's call it $1.10, right? So even if it sells off a little bit by the time you watch this, let's call it $1.10 for the December monthly $70 calls just to sell them naked. And now you know, also with the other video we just did, what it means to sell a naked call. So let's take a look at it. If we do sell the $70 call for $1.10, that puts our average cost at $71.10, which is right about here towards the top of the chart. So we have some room for the stock to continue should it have another good day or two. But ideally, we want it to close under $70 as far as possible. So we're getting the best of both worlds here. We're getting the ability for the stock to stay between 68, 69, maybe not pull back at all, or see it actually fall, and we'll make our premium or our profit from there. Now, where do you close the position? Well, if you sell it for $1.10, anything around 50 cents, right? If you could make about a 50% profit, that's pretty good on the trade. You're certainly welcome to keep it longer. It really depends on how fast it falls. So ideally, if it sits and does nothing for a few days and then slowly starts to pull back and then sits there and does nothing for a while, or simply just pulls back and then sits and does nothing, that would mean you would shoot for more of a profit. If it falls quickly, let's just say it falls the next day, the next day, the next day, right? You may want to take a smaller profit because it happened faster. The time decay, the premium built into that because there's so much time left until expiration may mean that it'd be better off to take the smaller profit. So it's really hard to come up with profit targets for these. It depends on how these things actually move. So I will actually cheer for it to pull back slowly and then sit and do nothing for a while, and we could just let that time decay eat away the price of our premium, and we'll collect as much as humanly possible. Well, that's our trade of the week. I hope you enjoy. I hope it makes you a profit, and we'll talk to you soon.